I see the bond market essentially pricing in still a very steep recession, and yet the stock market pricing in some kind of improvement in the economy. They both can't be right. Don Luskin, which one is right?
Oh, gosh, I think they're all right and they're all wrong at the same time.
How is that possible?
Well, the way it's possible is that stocks fell almost 60% from their October 2007 highs, and now they've recovered about 40% from the lows, which means they still have about, it still represents a fall of 40% from the all-time highs, and that has almost perfectly tracked the drop and the slight recovery in corporate earnings. So stocks are basically just doing what the underlying companies are doing. There hasn't really been a big change in value. So stocks, I think, are giving you a fairly accurate real-time commentary on what's happening in the economy. Bonds, on the other hand, are expressing all kinds of strange valuation issues. Treasury bonds have very unnaturally low yields because there's been such a panic from riskier bonds, from CDOs and mortgage-backed securities and all these exotic things that blew up in the credit crisis last year. Everybody's made a rush to Treasury bonds.
And yet corporate bonds.
And thank you, good cue. Corporate bonds have these extravagantly high yields, not as high as they did 6 months ago, but very high by present standards, because investors are being paid to take risks that almost nobody wants to take. So to me, that's where the action is, because what ought a smart investor to be asking himself? Where can I put my capital where it'll earn its highest use? Where is it most needed? It is most needed where other people are afraid to put it.
So the corporate bond market, you say?
That's right, the corporate bond market.
David Kelly, we got viewers watching right now. Do you agree with that? Is the corporate bond market the best place to be?
Well, I think you have to spread it around, but honestly, over the next 5 years, I think stocks ought to give you a better return. What I see is people have been beaten up by the stock market over the last 10 years. I think Don is absolutely right that stocks currently reflect current earnings. But the whole point is current earnings do not reflect what this economy can do in a recovery. So the real question is the economy. If the economy does eventually embark upon a long expansion, then stocks are very cheap. And although I'd want to have bonds in a portfolio, but I do think the stocks will win the race over the next few years.
Mike Pinto, what do you think? Are we about to embark on some kind of long-term recovery here? What are you doing?
Well, just ended a 30-year bull market in the bond market, and it's reached its apogee. And I believe that inflation is going to take off, and I think interest rates are going to skyrocket because the Federal Reserve has to unwind almost $1 trillion in treasuries and mortgage-backed securities. You add that to the $3.25 trillion they have to sell this year because of rollovers, and on our $1.85 trillion national debt, and you have to have interest rates skyrocket and inflation to skyrocket.
No,
that's bad news for the stock market. It's bad news for the economy, and it's horrible news for the bond market.
David Kelly, do I hear you trying to get in there?
Yeah, absolutely. I agree that we will see higher Treasury interest rates. We have to, given the amount of government debt the government is going to be issuing over the next few years. 5 times what
they sold last year.
Doesn't matter when it comes to inflation. The key thing, the Fed has got it right on inflation. You will not see inflation take off in this country with 10% unemployment or 9% or 8%.
But Mr. Kelly, you're doing a Phillips swerve analysis. I mean, the people of Zimbabwe have an 85% unemployment rate, and they have a 2 million percent per annum inflation rate.
This economy
if the Treasury spends and a central bank prints like we're doing today, you will get inflation.
All right, you make your point, Michael.
Absolutely not.
The analysis isn't right, but the debt analysis isn't right either. Why isn't there massive inflation?
David, and then Don.
Yes. Okay, it's about wages. We will not see inflation
to do with wages.
It absolutely does.
Michael, let him finish.
Well, if you're right, then the amount of money that the Federal Reserve has been printing over the last year would be causing inflation right now.
But it's excess reserves on the central bank's balance sheet.
So why can't it keep doing that?
So it will sit until there is real demand.
It has to be used to finance the Treasury debt. That's called monetization of the debt, and you always get inflation when that occurs.
Don Luskin, you want to weigh in here?
Well, Michael is basically making a prediction and framing it as though it's already happened. Yes, if the Federal Reserve massively monetizes all this debt, then I suppose that, well, some of us make predictions, some of us make predictions, some of us label them as such, not all of us do. The example of Japan in the last 15 years is an example of a country that's gone into enormous debt and in fact has even monetized a great deal of it and is right now still stuck in a great deflation.
You want to talk about their savings rate? Their savings rate is through the roof.
Well,
It's
but
like
you did,
16%.
but you didn't mention that until now. So how do we know that
Well,
our
because our
savings rate won't go up
Our
too?
savings
Our
rate is
savings rate
6%.
has gone up from -1% to +6%
Our savings rate
just over the
hasn't
last
gone anywhere
18
because
months.
the government increased
That's
its
not going
savings
nowhere.
by...
That's going from -1% to +6%. Is a gradient
But
of
Don,
7%
if the government
nowhere?
increased
Is
its
that nothing?
expenditures by 22%...
If 7% is nothing,
the
can I have
government
70% of
increased
70%
its
of your
expenditures
income?
by 22%,